Very good morning, everyone. My name is Fuyo, and thanks for joining us today. I'm a research analyst at iFast. So today, I'm very happy to share about investment landscape in Asia. And as we navigate through the complexities of the ongoing geopolitical as well as the economic challenges, I'm sure everyone will have this question in mind that where can we invest in Asia? And which markets can potentially generate us higher returns in the coming years? So recently, a lot of investors start asking me, hey, Huyo, whether China is back on its feet and whether we can reinvest into the market. How can I have a show of hands? How many of you here are also considering investing back to China at this moment or have already added your positions to the market? Well, I see quite a few here and there. Yeah, thanks so much. You can put your hands down. Yeah. So I think a lot of people's encouraging news comes from they saw the results that China actually generated a more than expected GDP growth in the first quarter. So China generated 5.3% of GDP growth, which is higher than the market consensus of 4.8. And this seems like a very exciting news. And since then, we can see that China's indexes, such as like MSCI China's, as well as CSI 300s, have increased steadily. But however, shall we just like go all the investment in and celebrate, say, hey, we should just invest into this market? I think we should pause and think. Because when we come to investing, many of the times investors tend to make one mistake, which is called chasing the market rally blindly. So in order to assess whether we can really comfortably chasing the market rally and whether we are going in the right directions, we should understand what are the drivers actually underpinning it. So in the first quarter, Chinese bullish result was mainly driven by a 6.1% increase in industrial productions as the global manufacturing sector recovers, and especially led by semiconductors and electronic products. Actually, there's more demand for Chinese goods in these segments, which is a very good news. When we look at the export, which is also grew by 4.9% in the first quarter. However, we noticed that it was mainly pulled by public fundings, which means that the private investments only grew by 0.5% year-over-year in the first quarter. And this indicates that actually the actual investment sentiment in China remains at a very low level. And move on to fixed asset investment, it also grew by 4.5% in the first quarter. However, we see that it was not due to the good investment sentiment. Another one, consumption, it also grew by 5%. However, we have to understand there's Chinese New Year in the first quarter and really add to a consumption in the first quarter and cause people to buying a lot of clothes and daily necessities such as food oil. And in that, if you look at the consumptions in bigger purchases such as like cars and properties, if you realize that actually people are not really buying into these big purchases as they remain very cautious under the current market conditions. Let's now move on to the property sectors. And this property market failed to surprise us again in the first quarter. If you look at the floor space of commercial buildings sold in the first quarter, it declined by 19.4%. And the weak demand actually translated into bad signs into construction activities and also investments into these areas. So as we know, if there's actually no one is actually buying it, then what's the point of building more houses or even invest in the area, right? So there's no doubt for us to see that actually the building starts as well as real estate investment actually continue their downward trends in the first quarter. And another key risk that we are really concerned about is deflationary pressures. So in February, the consumer price index actually increased up to 0.7% year-over-year increase. But however, we see that as the consumption normalized in March, it only grew by 0.1% in March. So which indicates that consumption actually really shot up. It increased is only because of Chinese New Year effects. And if you look at the producer price index, it continued to decline in March and declined by 2.8%. And this marks the 18th month of declines in Chinese histories. So this isn't good signs. And China's effort to combat deflations have thus very unsuccessful. And we are nowhere like nowhere near the 2% price growth target. So with industrial productions actually outpacing the demand, overall productions continue to exert downward pressures on prices. So in the first quarter of this year, if you look on the right-hand side of the graph, the industrial capacity utilization rate actually dropped to its lowest level since the second quarter of 2020. To sum up, so actually China's market actually face a few key risks at this moment. First, deflationary pressures may exacerbate amid weakening consumption and overcapacity. And second, China's real estate challenges have yet to reach a bottom. And thirdly, geopolitical tensions actually is posing a growing threat to key Chinese industries, especially its progress towards the higher-end tech development as well as the green energy transitions. Sectors like EVs, green energies, as well as medical equipment have already faced increased scrutiny from countries like the US and Europe. And there's another thing we have to take note. This year, US is going to hold its presidential elections. And Trump actually holds a significant likelihood of being re-elected as the US president. And we all know his stance towards China, and he hates China. So what does that mean? Here has a very detrimental effects on China's trade restrictions on this sense. And that could impact China's economic results in the following quarters. So it seems that China's GDP growth is not as strong as it's suggested on the headlines. So I think the next natural questions that will come to our mind is, if we don't invest in China, then where else can we invest in Asia, right? So we have actually selected 5 criteria to help us identify the new Asian tigers that can maintain a dominant positions under the current environments. So first, we believe that the country should be a beneficiary of the shifting geopolitics. And secondly, it should experience a sustainable economic growth. Well, there's a couple of ways for us to look at the economy's growth, but we think that one of the important factors could be current account balances. If an economy can achieve a continuous current account surplus, then it is likely to experience a strong growth in the following years. And thirdly, we believe that there should be supportive government policies in place to support economies and even accelerate the growth of certain key sectors. And fourthly, we believe that the market should be a technological leader in certain ways. And the last but not least, we believe that the market should have produce some world-class brands. And these brands, well, this make these economies visible to the world. And this brand will also contribute significantly to the growth of the economy. So as that said, we have selected Japan, South Korea, and Singapore as well as our new Asian tigers. So our first new Asian tiger is no other than Japan. After a prolonged period of low, or you can even say like negative interest rate era period, the post-pandemic pickup in inflation is more welcome in Japan than anywhere else in the world. So you can see that Japan's inflation actually stayed above 2% since March 2022. But what really makes investors buzzing this time is that the inflation doesn't only increase the prices of the goods and services in Japan, but also helps improve people's paycheck this year. If you look at the Shantou wage negotiations, large organizations, they agree to increase the employees' paychecks by 5.28%. And this marks highest pay hikes in 33 years. And with that encouraging signs, actually Japan exited the negative interest rate era in March this year. And this, which means that there's actually a cost to holding cash. And we see that as a household has increased their disposable income, they will translate that into private consumption and support economic growth. And that also means differently for investors, because now they find the riskier assets, such as equities, as a more compelling or attractive investment class compared to just cash in order to protect the asset from the inflations. And we can see that when we look at Japan's current account balances over the years, we see that even though its economic growth in the past 2-3 decades has been remaining very boring, the country was still able to maintain a positive current account surpluses over the years. And we see that as a positive sign to support its economy going forward in the later years. And apart from inflation, actually there's a stronger investment case for Japan in the longer term because corporate reforms are actually making a breakthrough. As shown on the diagram, you can see that Japanese policymakers have made it an objective to improve Japan's corporate governance, and they have started it back in 10 years ago. So unfortunately, these measures were halted during the COVID period. But once the Japan's economics reopened, the policymakers are making a strong push again. So last year, March, the Tokyo Stock Exchange have issued a mandate and pressurizing the corporations who have low PB ratios below 1 to use their capital more efficiently, which means that they have to pay higher dividends to the shareholders or buy back the shares. And we deem this mandate very effective because upon the release of this, many organizations have started to do so. And these organizations include Mitsubishi and Toyota. So we can know that Japan has quickly become a hunting ground for investors seeking stock that are not only fundamentally strong, but also provide better shareholders' value for those investors. A revival Japan can also be seen from the countries aiming to regain its status as a semiconductor powerhouse. So Japan, whose chip makers actually dominated industries back in 1980s, but then it lost its grounds to South Korea and US in the later years. However, it has now realized the importance having a strong foothold in these semiconductor industries and initiate a new project called Rapidus. So it is a consortium that comprises of the 8 companies shown on the slides. And this Rapidus is now working with IBM from the US to developing 2 nanometer technologies by 2027. Moreover, as the global companies diversify supply chains away from China, Japan will benefit from it. The Japanese government has also provided a lot of subsidies for new plants to be built in Japan. And these policies actually has attracted prominent players such as TSMC and Samsung. And these efforts will not only help Japan to regain its status as a semiconductor powerhouse, but will also strengthen its semiconductor supply chains. And this will ultimately benefit Japan's industry, including automotives and electronic components, which will rely on the strong semiconductor supply chain for long-term growth. So when you talk about the industrial, in Japan, definitely there are some brands will come to our mind, such as Panasonic, Sony, Toyota, Mitsubishi. But of course, I think the younger generation are also very familiar with the Japanese game console brand, which is called Nintendo. So that's how Japan makes its economy more visible to the world. Let's now move on to the second new Asian tigers, which is South Korea. And while South Korea is very famous for its K-pop music and also TV dramas, the country is also very well known for its technological prowess and also innovations. And this is largely supported by its educated workforce. So with barely any resources actually on hand, the country has pursued a very export-driven strategy aiming to maximize the exports products. So the economy, we can see that has been increasing steadily over the past 1 year, and with the pull from higher export growth from industries like semiconductors and electronic products. So the key reason we really like South Korea is because it is a well-established semiconductor powerhouse. So as the world advances in the digital era, we know that actually the fuel to power the data-driven economy is definitely the semiconductors. And semiconductor actually makes up 20% of South Korea's GDP. And this country also have a dominance in the key memory chips and DRAM market shares. You can see it on the graph on the right-hand side. Actually, Korean makes a large proportion of the total world's market shares in terms of memory semis, DRAM, as well as NAND. And this has made its domestic players such as Samsung Electronics and SK Hynix top on the list of the top semiconductor companies by revenues in 2023. So South Korea has been able to consistently maintain a current account surplus and witnessed strong economic growth over the past decade. So besides being known in the area of semiconductor, South Korea has also been able to propel itself in the global arenas with world-class brands and corporations such as LG and Hyundai and Samsung. And I'm sure many of you sitting here are still using Samsung phones or using Samsung TVs at home. And these are just some examples showing that how visible these brands are to the world. Last but not least, we go all the way back to home. So as actually it's the only major financial hubs in the Southeast Asia regions, Singapore plays a very important role in intermediating the capital flows in these regions. And the country is very open and has attracted a lot of foreign talents to fill up the gaps in terms of the job positions here. And the government also has a very entrenched mind of investing towards prosperities and building on its cash offers. And this has make Singapore one of the richest countries in the world with enviable foreign reserves. And this has helped Singapore to maintain a high current account balances. You can see on the graph that actually Singapore's current account surplus meeting at a very high level, and it's been consistent over the past decades. Its strong economic fundamentals and fiscal positions has also translated into the strong appreciations of the Singapore dollars over the past few decades, and making Singapore dollar one of the strongest currency in the world. So amid ongoing geopolitical tensions between the US and China, Singapore has also reaped the rewards of heightened capital inflows and reallocation to the region. And this is driven by its transparent legal regimes and stable macro conditions. We can see from the graph that Singapore actually takes up the majority of the foreign capital inflows into the ASEAN region. And two key areas that really attract the foreign capitals. One is manufacturing. And Singapore is an active player in the downstream of semiconductor manufacturing. As the semiconductor industries recovers from the downturn, I'm sure you have heard it from my colleagues' introduction about semiconductor in the previous presentations. And Singapore's economic export are expected to pull up the economic growth in the following years. And the second area that really pull a lot of capitals from overseas is insurance and the finance sectors. As actually Beijing tightened its grips on Hong Kong as well as Chinese entrepreneurs, many of them has increasingly moving their funds overseas. And Singapore has become a top destination for their funds outflows from China. And what's the reason because of that? Singapore has a very stable macroeconomic conditions and very transparent region, and they regard Singapore as a safe haven to reallocate assets. And apart from that, actually Singapore government has given a lot of incentives for them to build single-family offices here. And we can see that in this way, as China and US, I think the geopolitical tensions are unlikely to come to an end in the following years. And this capital will continue flowing back to Singapore and sustain the economic growth in the following years. So with that, you can see that Singapore's financial system is very strong and has produced some great brands such as DBS, OCBC, and UOB. And at the same time, Singapore tries to diversify its economy just from financial hubs. It has also expanded into other regions like tech, as well as tourism. And that's why we have produced one of the best airlines in the world, Singapore Airlines. So to sum this up, we believe that the three new Asian tigers, Japan, South Korea, and Singapore, are more compelling investment options in Asia amid China's continuing economic challenges as well as geopolitical tensions it faced at the current environment. We believe that you should allocate your capital to somewhere that it can sustain its economic growth in the following years, that face less risk, and it can even benefit from the current risks under the current environments. So for that, for investors who want to partake in the growth of Japan, you can consider the X-Tracker Nikkei 225 UCITS ETF. And for those who want to invest in South Korea, you can consider Franklin FTSE South Korea ETF. And lastly, for those who are very confident in our own economies and to partake in the growth of Singapore, you can consider Nikko AM Singapore STI ETF. So that I have come to the end of my presentation, and thanks again for coming and joining us today, and hope you have an enriching lesson today. Thank you.